Good morning, everyone. Welcome to this morning's webinar on project finance, hosted by the UK-Ghana Chamber of Commerce. My name's Alice Asafwa-Jay. I'm an architect based here in Accra, run a studio called Mustard. And I'm also a board member of the UK-Ghana Chamber of Commerce. So project financing. So we are here really to discuss infrastructure and the project financing of that. So infrastructure, as we all know, and those, some of us know more than others, obviously. Infrastructure is the key to driving the socio-economic growth of Ghana and also really the reduction of poverty in Ghana. So we're focusing on Ghana in this webinar. And the infrastructure, the development of infrastructure presents exceptional opportunities for investors who are willing to finance Ghana's development. So this addresses the widening financing gap between the infrastructure provision and funding in Ghana. And really, the aim is to really the intention is to raise billions of dollars annually by the government. Project finance provides an innovative financing approach to developing major infrastructure projects across the globe. And in Ghana, last year, 2020, the government passed the PPP Act, so Public-Private Partnership Act. And the aim is the government is seeking to use the PPP model to deliver major long-term projects in the country. So the UKGCC presents this capacity building workshop today. Our aim today is really to present this workshop to equip all the participants with up-to-date knowledge and skills for success in their businesses, as well as to contribute to the bridging growing knowledge gap in this area. And this is something that I actually feel that I personally, as my business could benefit from. So here to present to us today is Stephen Gray, our Vice Chairman of UKGCC, and Stephen Gray is the CEO of Wardour Global Limited. So more about Stephen, and I'm going to read his CV. I was just saying to Stephen that I've known Stephen a couple of years. I felt I knew him, obviously in a business and social capacity, but reading his CV now, I'm actually blown away. So I'm going to have to read, so bear with me. So Stephen is an accomplished senior manager, seasoned in 30 plus years of demanding multinational roles, spanning challenging societal and economic environments across Africa and the Middle East. Within the trading, logistics, construction, infrastructure, and mining sectors. Stephen has been involved in delivering financing solutions on various projects, including the structuring of non-recourse finance on projects in Africa and South America. Stephen has held a number of non-governmental organization board positions, including the Vice Chairman of the UK-Ghana Chamber of Commerce and the high-level advisory board of Digilogic that seeks to support digitizing logistics in Africa and exploring the leapfrogging opportunities for technologies despite the infrastructure deficits to improve the final mile delivery. So, Stephen, welcome. Before we start, just a couple of housekeeping notes for all of us to bear in mind. We encourage you to participate in this, active participation throughout this session. You can enter your questions and comments in the question pane throughout the presentation. There'll also be a Q&A session at the end of the presentation. So now, without further ado, I turn over to Stephen. Thank you, Stephen.
Alice, thank you. Thank you very much for that very kind introduction. And good morning, ladies and gentlemen. It's a real pleasure to be here today. And this is my second webinar for the Chamber as a presenter. The first one I did a couple of years ago that outlines the Ghana infrastructure plan out to 2047. And today is a natural progression, given, as Alice mentions, the passing of the PPP Act in December last year, which seeks to provide the regulatory and legislative framework for projects to be financed through public-private partnerships. But for today, just to talk about the financing of capital projects, I think it's important to remember that capital projects can be financed in a variety of ways. It can be asset-based, it can be corporate finance-based. It means to say that it's levering the cash flows from an existing business, or it can be financed on a project, none or limited recourse financing, which is popularly known as project finance. Project finance is a complex form of financing, and you will need a session that runs over a number of days, if not weeks, to get into the detail and fully understand the complexity of project financing and the various considerations and facets that come together to make up a project finance deal. So today, I'd just like to start by outlining the objectives of this presentation before we go in. There are 4 key objectives today. One is to outline the different types of finance sources for infrastructure projects, explain why project finance is a solution for financing and where it is suitable, and equally important, where it's not suitable. Talk about the principles of risk and risk allocation, because at the end of the day, the ability to finance projects is about how risky it is to finance. And then finally, to close the session, just to highlight some of the keys to project success and some of the reasons for project failure. But let's, picking up on Alice's comment about the infrastructure development in Ghana, let's just take a moment to take stock of what is the plan in the Ghana infrastructure plan out to 2047. It identifies that there's a need for the country to invest $1.1 trillion up to 2047 to build the infrastructural platform that supports Ghana's prosperity and economic growth to a upper middle income country. You know, that's a considerable amount of money when you consider the restrictions on the fiscal space. But where is that money being spent? The sort of key 6 infrastructure sectors, ICT. You know, we've seen in the past year the importance of ICT to the continuation of commerce and activity. And within that space, the government have clearly focused on private sector to leverage financing in to deliver those through PPPs. Transportation, the investment required out to 2047 is $331 billion, and expanding the road network by 3.5 times across the country. Water and drainage, you know, so important. Alice talked about the threat of rain today. How many times have we seen areas of Accra and other parts of the country being flooded because of the inadequate drainage resulting from, some say, climate change, but certainly inadequate infrastructure to support the response to drainage. But with the increase in the population, also possible water is required. But in that sector, $129 billion required. Waste management, again, an important but often overlooked part of infrastructure requirements, nearly $18 billion. Housing, you know, we all know about the housing deficit in Ghana. There's nearly $1 trillion required to support the infrastructure, the housing gap. And energy, again, 168 billion. So we've got some fairly significant numbers here. And no one company, no one individual has the money that can fund that on their own. So they need to leverage in capital from other areas. And that is normally leveraged in through project finance. How is the government looking to fund this development? You can see the $1.1 trillion of uses in the various sectors there on the right-hand side of that column. But the sources the government have identified can come from taxes, GET fund, road fund, property taxes, etc. But they also identify that a foreign direct investment could bring in $2.7 trillion of capital. to fund the infrastructure developments, and that would be done through PPPs. So this is why we're focusing on project finance today, to give people a basic grounding on what project finance is, because it's an important and a key element of Ghana's future infrastructure developments. But in terms of financing infrastructure, what are the approaches? It can be broken down into two very basic elements: the public financing space and the private financing space. On the public side, you can see public ownership, and then we often see a lot of the infrastructure assets in Ghana are owned by the governments. And the procurement of that is through the Public Procurement Authority. But equally, we're now seeing PPPs coming in. If you go onto the private sector side, you can see corporate finance that leverages funding from the balance sheets and cash flows of an existing business. Or you have project finance that is seeking to raise finance through a specific project company. And that can either be as a PPP, where there is a delivery of a public good, and the private sector is working hand in hand with the government to deliver that public good through a PPP. But you also see private sector developing projects through non-PPP models, where there is no involvement of the government, but in order to reduce their exposure, their risk as the parent company, they want to limit the recourse obligations and the financing to a specific project company. But what are the deciders? Why do they look at project finance? Obviously there are many reasons why it is attractive financing solution. But the primary one is that it's a limited recourse to the sponsors, so that in the event the project fails, because every project has its risks, some projects fail, some projects succeed. But in the event of failure, the recourse to the parent company, the recourse to the wealth of the sponsor or the corporation that's pushing the project is protected, so that one project failure doesn't mean a complete failure of the overall corporation itself. And so the lenders are lending to that project based on the cash flows and the contracts that are in place. And so it gives the ability of sponsors to finance larger capital projects than they could otherwise do based on the size and strength of their own balance sheets. It is also an off-balance sheet treatment, so that gives that protection. And just to explain, off-balance sheet financing is an accounting practice whereby a company does not include a liability on its balance sheet, and it is used to impact the company's level of debt and liability. Common forms of off-balance sheet finance, including operating leases and partnerships. Operating leases have been widely used, though accounting rules in recent years have been tightened to lessen its use. And so, for example, a company can rent or lease a piece of equipment or infrastructure and then buy that equipment at the end of the lease period for a minimal amount of money, or it can buy the equipment outright. In both cases, the company will eventually own the equipment or the building. But if the company chooses an operating lease, the company records only the rental expense for the equipment and does not include the asset on its balance sheets. However, if a company buys the equipment or the building, the company records the asset and the liability on its asset sheet. And by using the operating lease, the company records only rental expense, which is significantly less than the entire purchase of the price and results on a cleaner balance sheet. So it's an accounting mechanism to give the company's ability to leverage more financing. And on that leveraging, project finance can leverage in, based on the strength of its cash flows, more debt. And why do you want more debt? Because it's cheaper than equity. But the level of debt that you can leverage in is a function of the security and confidence and the predictability of the cash flows that are available to service that debt. Additionally, you can get longer tenors on project finance compared to corporate debts. Corporate debts facilities tend to be relatively short, 5 to 7 years, but when investing into infrastructure, the returns on those are over a much longer period. And so typically you're looking for 10, 14, even 20-year debts on project finance, which you can access on project finance structures, but you can't on the corporation. But also the robust risk allocation reduces the return of requirement for investors. So you're de-risking the debt providers' investment into a project, so that they can then, with a lower risk, can reduce the pricing of the debt that goes into it through project finance. But additionally, it also helps you bring in, as a project sponsor, multi-sponsors coming into the same transaction. You may not have sufficient strength to do the project on your own, and you may need to bring in additional shareholders and sponsors into the project developments. Now, typically, you wouldn't want them to come in at your corporation level, but you're happy for them to come in at project level. And so that then, again, mitigates the exposure to other sponsors in the wider corporate structure. So those are some of the reasons why people will look at project finance over other forms of financing. So just to reinforce, what is project financing? It is a limited recourse financing. So debt is raised to finance a project that is secured only by that project company's cash flows, nothing else. There may be sort of limited recourse to the sponsors, and we'll touch on some of those security elements later in the presentation. But the project is typically ring-fenced as a special purpose vehicle, so limiting the recourse to that limited liability company. And if the project is unable to meet its debt obligations, the lenders can't pursue the sponsors for payment. So again, it's just protecting the sponsor's corporate structure above that. The repayment is based on the project cash flows, and so the importance of the market risk, the reliability and predictability of clients taking or paying for those services is so important in project finance. It is one of the underlying fundamentals of success for a project finance deal. And the credits of the project, the credit rating, is driven by project characteristics rather than the credits of the individual sponsors. And project finance is also about allocating of project risks. So allocating them to the parties that are best able to manage them or mitigate them. So, for example, there's no point putting the risk of governments changing legislation on the private sector shareholders, because they have no ability to manage that. That is purely in the remit of the government. If they want to change legislation, that's their rights and ability to do that. But the risk of changing that and the impact of that risk needs to be understood, but placed with the government, so that if they make changes, they understand the cost of making those changes. But equally, the ability to conclude the construction of the project, that is a risk that shouldn't be on the government. It should be on the EPC contractor who's delivering it, because they are the ones controlling the construction of the project. And without that construction being completed and the project handed over, the asset itself will be unable to start earning money. Sorry. So what are the typical projects that can be supported by project finance structures? Well, on the screen here, you'll see images of a wide variety of projects. Industrials, refineries, petrochemicals, for example, cement factories. Here in Ghana, we have quite a large number of independent power producing projects that have been financed on project finance principles. Infrastructure, again, toll roads we see within the region as being financed on project finance, where the cash flows generated from the tolling charges of roads driving along that road are used to service the debts. Telecoms companies as well, and you can see here a whole range there, which are appropriate for non-recourse financing based on the cash flows, and sponsors can then leverage in capital that they don't have on their balance sheets, but from banks who are willing to invest in them. But how does that all come together as a structure? Who are the parties in a project finance deal? I've talked about the project company, and you can see on the screen there in the center, the project co. Above that, you'll have your equity partners, starting with the sponsor who's initially driving the concept of doing a PPP project, a project finance project, and potentially other sponsors, investors around that. But in order to get sufficient capital, you have the commercial banks, the lenders that are lending into the project company. And to the left-hand side, you have the various other parties that ensure the delivery of the project, from the EPC contractor, who would be contracted to build and deliver that project, that infrastructure, to the specifications demanded by the project code. In PPP projects, you'll have government agreements because governments are giving a right for that infrastructure to be built and revenue to be earned from that by the project company. Depending on the type of project, you'll have contracts with off-takers who are buying the service. But other times you just may be having complete market risk, such as a port project or a road project, where you're relying on the regular flow of vessels or cars that will be paying for that service. But equally, you could have, for say, an airport, you have an airline that's actually as a contracted off-taker for renting space on the airport for the hangars, and have agreed to allow a minimum number of airplanes into that airport during the course of the year. And those sort of contracts then start giving you predictability of cash flows. Obviously, there are risks in projects that are covered by insurance. Those in the infrastructure sector will know the contractors' all risk policies. So you have insurance providers there covering some of the risks there. But equally, for example, on the power projects, key stakeholders would include the providers that are of the input fuel, be it oil or gas. If you don't lock in your inputs, your gas supply or your oil supply to the power station, you're not going to produce power. And equally, if you don't have an O&M contractor that's obliged to maintain and operate that facility, you could be facing considerable challenges in the projects because it's not being maintained and operated correctly. So how does project finance differ from corporate finance? Corporate finance is, the borrower there is basically a company, a corporation, and the ability to lend to that organization is based on its credit standing, and banks will do the analysis on the previous 3 years financials of the company, and increasingly with COVID, they'll be looking much more closely at the future projections of a corporate company. The securities that lenders will be looking for are over specific assets, and assignment of contracts is not necessary for corporate finance. The revenue flows, all revenues are paid into corporate accounts. Unlike in project finance, where revenue is paid into project accounts and there's a cash waterfall mechanism that meets the costs of the business and then servicing the debts. On the covenants that corporate finance structures require, the corporations are making negative pledges or standard corporate covenants, whereas in project finance, you have very clear rules that you have to work under. It's much more straitjacketed in terms of project finance, including undertakings not to take out additional indebtedness on that project finance. And distributions to sponsors, then under corporate finance, there is no restriction under the corporate finance structures, except if there's particular defaults, for example. But again, under project finance, the distributions to the sponsors, the dividend payments are much more closely controlled, and there's a requirement to ensure that there are minimum capitals amounts in the bank accounts to be able to service debts and to cover maintenance of facilities, etc., and that there are no events of default in the project at all. So corporate finance, very much looser controls on the corporates to do what it wants in its business. Project finance, very structured and very restrictive as to how that business can then do more financing and leveraging from the business. So that leads us into when is project finance not appropriate. As you can see, there's quite a lot of structuring to do with project finance, and there's a lot of cost associated with preparing infrastructure projects. Typically, based on research that's been done over the years, you can see the cost of preparing a project finance deal somewhere between 5 to 7% of the overall project. So if it's a $100 million project, you could be very easily, well, you need to budget for $5 to $7 million to prepare that project to a bankable standard. Now, if the project is much smaller, the percentage goes up, and I've seen cases where that's gone up as high as 13%. Now, one has to ask, if you're spending 13% to get a project to financial close on a PF deal, are the returns in that project high enough to warrant the early upfront costs? Often it's not. And so many banks will really only consider project finance deals above $40 million because of that high cost associated with preparing a project finance deal. So smaller value projects need to look at alternative forms of financing that, either through corporate financing structures or other public methods. Now, some project sponsors will see that an asset is too strategically important to be able to lose control of that, and through the enforcement of security by lenders. And so in those instances, you see sponsors saying, we'll find another method of financing through corporate finance or capital market solutions. Covenants and reporting requirements may actually reduce the operational flexibility on a project that is innovative, looking to respond to an emerging opportunity and needs the flexibility to be able to respond to that. That isn't suited for project finance. Project finance looks to get certainty and predictability about cash flows. If you're in a sort of disruptor business, project finance is most likely not to be suitable for that. And also, depending on the final risk allocation, the structured finance debt can be more expensive than corporate debts, because as you structure in risk mitigants, there is a cost associated for that. And you may find that ultimately the cost of that is far higher and the returns are considerably lower than if you use the corporate finance structure. Now, you've heard me mention repeatedly so far this morning about risks. But I think it's important just to take a moment to remind ourselves of Donald Rumsfeld. If you remember, he said, as we know, there are known knowns, there are things we know we know. We also know there are known unknowns, that is to say, we know there are some things we don't know, but there are also unknown unknowns, the ones we don't know we don't know. And I brought that up because there is a difference between risk and there is a difference between unknowns. Risks are in the Rumsfeld statement, the known knowns, and to some extent the known unknowns. And risk is really looking at an event that you can measure, and if you can measure, you can then price the cost associated with that risk. Whereas with unknowns, you can't measure anything. And if you can't measure it, then you're going into the abyss, you're going into the unknown. And so, as I say, with risk, they are uncertain or chance events that planning seeks to overcome or control. It is a possibility or a probability that a project will not turn out as planned or designed, and the effect of uncertainty can be on the objectives. And we measure risk using two concepts: the likelihood an event will occur and the impact of the events it does have if it does occur. So I'll give you a couple of examples of known unknowns. Exceptionally inclement weather. We know that we'll get some exceptional storms throughout the year, but we don't know when it will happen or for how long. But in that case, we can use statistical analysis based on previous weather patterns to measure that risk and put a cost associated with that. But there are other known unknowns that we don't have enough data to measure on. And say in the IPP, in the power space, if you look at the mini grid going into a community, you know that there is a potential challenge around the affordability and the willingness to pay, but you don't know what the answer to that is. And where you go, unknowns, you just don't know what they will be. But in that last case around the mini grid concept, we know there's going to be a risk there, but we can't manage it. And for me, that then becomes into the unknown territory. If you can't measure it, you can't price it, then are you prepared to put your money into that project, not knowing what the potential impact of that is going to be on your bottom line? But is risk static over time? Clearly it's not. You know, and on the screen here, you'll see the sort of the profile of a business of risk versus revenue over time. At the very beginning of a project, you know, the risk is very high. There's no revenue, and so if it fails, you've got no cash coming in to recover the costs. As a project comes into growth and commercial operation, you know, those two lines intersect where revenue exceeds the risk, and it achieves a peak. And then as that project in later years either declines in asset quality or the market has moved on and no longer using that infrastructure. You often see this in the office space, the commercial office space. The old office stocks today that were built in the 60s are not appropriate for modern means. And so you either have to refurbish that or you demolish it because it's no longer attractive to the markets. So risk does change over time, and that risk profile has different types of capital that is willing to come in those stages. And that's no different with project finance. At the very beginning, the risks are so high that you're unlikely to be able to leverage in debt unless you're using a corporate finance model. So really you need to go look towards what I call the three FAs, friends, fools, families, and angels, or go look for grant funding, public financing, or seed funding to be able to move that initial concept to a point where the market feels that there is enough demonstration of the demand for the project to put money in. And that's when you start seeing venture capital, private equity, and concessional debt coming in. And then later, once the project is fully de-risked, you can then look at public markets, capital markets coming in to those projects. But you know, we talk about this concept of risk, but how do you actually measure that? You know, how do you compare one transaction is better than the other? And that's typically done through the credit rating profile. You know, we've all heard about Ghana's credit rating. You know, and there are credit rating agencies, Moody's, Fitch, S&P Global, that are seen and recognized as sort of leading organizations to come up with credit ratings of sovereigns, of corporations, but also on projects as well. Now, the ratings ladder is shown on the screen here is basically split into two parts. Investment grade, which goes down to BBB-, and where there is investment grade, a lot of lenders will quite happily invest into those spaces. But if you go below BBB-, we're then getting into the speculative space, and some of the global financial rules will prevent certain investors supporting transactions that that are graded at that level. But this grading structure represents an assessment of both the qualitative and quantitative aspects of risk in any projects or organizations. And the higher you are up in the credit ratings at AAA, you know, that is gilt edge, and you know, people see that as very low risk and prepare to lend money at a very low cost because of the low risk. If you go to the bottom end of the scale, you know, you will find people will be unwilling to lend at all down at D credit rating. But you may start getting people coming in at CCC plus, being prepared to lend, but the cost of that lending is so much higher than a AAA. But in terms of the ratings universe, who's you know, where do people sit? You know, sits on the sovereign side. You see Switzerland at AAA, Ghana is down there with Nigeria at B-. On the corporate side, Microsoft at the very top, and you know, coming to some names closer to home like MTN are at BB, UBA Bank from Nigeria at B-. So the cost of capital for those different organizations is very different. And so would project finance. So the more you're able to structure the deal to push up the credit rating of a project and a project finance deal, the lower the cost of the debt from the banks. But of course, there's a cost associated with the mitigation. Well, what are the categories of risk we tend to look at in the delivery of projects and project finance deals? You've heard me say this morning about the market risk, the offtake agreements. Fundamental, at the end of the day, project finance is about being able to service structured deals where the debt can be serviced from cash flows. And if it can't be, then you need to increase your equity. And equity is an expensive form of capital to put in. And so that would lower your leverage into a transaction. Your main mitigants in relation to market risk is long-term tolling agreements, or if in the example of the power sector, you see the take or pay provisions that regardless of whether the power station is being called on to supply electricity, the off-taker is obliged to pay for that through a capacity fee. And then that gives confidence to lenders on the reliability and predictability of cash flows. Political and regulatory risk, again, very important. Regulatory environments, investors need to have confidence that it is reliable and predictable, both in terms of regulations and also in legislation, and the tax regime that one operates under. Clearly, that is in the control of the governments, and discussions in project finance deals will be looking at moving an obligation on the governments to ensure that there is both fiscal, regulatory, and legislative stability for that particular transaction. And that can, in terms of the legislative stability, that can go down to either general legislative stability, but you could also see clauses coming into contracts, concession agreements that talk about the specific discriminatory legislative changes for that project. That means to say that it discriminates that project rather than the overall sector. Completion risk, if the project is not built, then the ability for that asset to earn money is negated. And so this is the risks in completing include the acquisition of the sites, the construction cost overruns. If it costs more than budgeted for, where's the money going to come from to pay for that? Inadequate performance of the infrastructure once it's built, particularly in power stations, for example. If the contractor brings in a turbine that burns far more fuel and produces far less electricity than specified, that's going to disadvantage the project and not be able to earn the revenues that it was anticipated in earning. Force majeure, acts of God, exceptionally inclement weather, all of these things come to completion risk. Even COVID in the last year is an example of one of the completion risks. Now, how do we mitigate those? Some of those can be mitigated by ensuring that you pick credible EPC contractors with the EPC contract very clearly articulating the responsibilities and the penalties on the contractor. Well, penalties is the wrong word, but the recovery of costs resulting from the delayed completion within those contracts. And for cost overruns, sponsors will be asked to provide additional support by way of standby financing should construction costs overrun higher than anticipated. And also you can mitigate it by using proven technology. If you're using something that hasn't been used anywhere else in the world before, there is always a risk that that technology may not work. And so you can reduce your completion risk by using known technology. Operational risk, again, important. If you're not operating and maintaining your infrastructure assets as appropriate or at a much higher cost than required, that's going to impact the ability to service the debt. And therefore, one of the main mitigants is ensuring that you have a party under a long-term operation and maintenance agreement, which can deliver those services, and that if they fail, there is sufficient recourse back to them to ensure that the project can recover the costs associated with that. Macroeconomic risks, of course, very difficult to mitigate those, with the exception of some instruments like hedging for interest rates, for example, or even exchange rates. Exchange rate hedging in West Africa tends to be quite expensive because of the inability to predict where exchange rates are going. And inflation, again, important elements of one of the risks that's particularly in a regulated environment. If your tariffs that you're charging for the infrastructure is regulated by the government and you can't increase your tariffs in line with local inflation, again, your ability to service debt may be compromised. Force majeure, talked about naturally inclement, exceptionally inclement weather, and political force majeure events like strikes and wars, that you can insure those risks. So that would be a key mitigant in that space. And the last but not least area of risk that people look at is the environmental and social impacts. And it's an area that a lot of people don't give sufficient attention to. It's often the area that creates the greatest friction to time to completing a project. And some of those risks could include human rights ignored and loss of livelihood as land is taken over for projects. There could be loss of vital habitats. For example, a project may be built on an area that is important for the watershed, for urban drinking water. Or you can have loss of habitat for endangered migratory birds. Ghana is a wintering habitat for the sanderling that comes down from Europe every year. And so if you're destroying those habitats, those are issues that people really do care about and want to ensure that we don't lose species. Again, with climate change, people are looking increasingly as well at how do we make projects net zero. So elements of if there's a negative impact on climate change, these are risks that banks in lending money into transactions will look at very closely. And then the mitigants in that environmental space is one, making sure that you have robust surveys that have been done to the international standards like the Equator Bank or the IFC performance standards, and then amending the design of the project if possible to reduce or mitigate or completely take away those risks. Or in the case where there is resettlement of people, ensuring that the compensation is budgeted for, that ensures that those livelihoods are not diminished on the project, so that in resettling them, their livelihoods remain the same, if not enhanced, through that resettlement process. So once we've identified those risks, how do we allocate them? Well, here on the slide, you can see the three key parties. You've got the government on one side on a PPP, and then you have the contractors on the other side for the construction part, and then the residual risks then sits there with a project sponsoring company. But this gives you some of the areas where there's clearly overlaps between those three key parties in terms of risks. But having identified them, having allocated them, where do they get codified in terms of who's responsible, who's been allocated them? And that again, just going back to the project structure, you can see here on the screen the various agreements in place. So off-takers, purchase agreements would deal with that market risk. Government agreements is through the investment license and permits and support agreements signed. EPC contractors, construction contracts will capture those allocation of risks. And importantly, commercial banks, want to be able to see the risk that if the project fails to service its debt, they have to step in. And so the banks need to have comfort that if they do have to step into a project, they have already agreements in place with key stakeholders, key contracted parties, that they would be recognized in stepping into the transaction. So documentation is very important to financiers in project finance, and having the right legal counsel in place to make sure that the documentation suitably and adequately articulates the allocation of the risks and the responsibilities around those risks is important. So having identified those risks, you then go to the market to try and raise money. And the sources of money are different over the courses of time. Here you'll see during the construction phase, bond debt, bank debt, export credit agencies, junior funding that sit behind the security of the projects. You sit behind the commercial banks, mezzanine debt and equity, They get their money once the debt providers are satisfied. And then you have revenues through pre-completion and then afterwards. In turn, I just wanted to touch on bond debt. The bond debt is normally, it is seldom seen in the construction phase, but it has been seen. And it only really comes in with highly structured deals that has credit enhancement tools that brings it in line with the credit quality of their investment rules, i.e. typically investment grade. And so that can be done, but it's not a regular feature in construction phase for bond debts. Keys to project success. First and foremost, there must be a compelling need for the project and strong fundamentals to deliver predictable costs and secure demands that helps really leverage in debt to finance a project. Now, in order to articulate that, one of the most important things you must have is advisors who will tell you how to structure a project and finance it. Over the years, I've seen many projects where the project sponsors have paid considerable sums of money for the technical advisors to come up with the right designs, but they've ended up going to people who tell them what they want to hear and invariably don't structure it in a way that can unlock money. So, if you are to bring on advisors, make sure that you have credible advisors who really do know how to structure deals and leverage your money. They'll give you some very hard messages telling you what needs to be done to finance a project. But I personally would rather have somebody to tell me the reality rather than telling me what I want to hear and waste considerable time and money on a fool's errand. Proven technology. The technology risks are high. Lenders are not in the market to take technology risk. They can't take that risk. The supply agreements and cost competitiveness, again, very important. There's no point building a project that is not that is meeting a market demand but is not competitive in the market unless it's a monopoly. But if it's a monopoly, then you'll invariably find it's regulated in terms of its pricing. Another part of a key success for a project is the offtake agreements, making sure that there are clear off-takers. Lenders will get greater comfort if there is an offtake agreement that gives them predictability and reliability on the cash flows. But that's not enough in itself. They need to see creditworthy off-takers. If you had an agreement with a company that agreed to pay you $100 million a year for that facility, but they had never traded before with no balance sheets, well, that's not credible and nobody's going to get any comfort from that. So quality is as important as well as the agreement itself. Sponsor groups. Lenders are looking beyond somebody looking for somebody who is more than just someone who has a good idea. They need to make sure that the sponsor group, the equity investors, there is alignment of interests, that they're not, that they actually have sufficient gravitas, that they have expertise and knowledge of the sector that they're building. And that you also bring in partners that are able to manage the risk, including local partners. I'm a strong proponent that international investors coming into a market should bring on local partners to not only share the prosperity that's created by the investment, but also that local partners are able to manage local risks in a way that international players can't. Equally, realistic objectives, making sure that you have reliable contractors who can deliver, reliable operators who can operate accordingly, and that the contractors that are being brought on board have the credibility of delivering on the projects. Acceptable sovereign risk. Again, we've seen in various jurisdictions over the years, the sovereigns changing their views on these PPP projects. They're long-term projects, and a view today may be very different of a sovereign view in 10 years' time. But lenders need to be comfortable that the attitude of the government towards the credit support is appropriate, is solid, and is enduring and sustainable. And if there is uncertainty around that sovereign risk, then you need to look for political risk insurance. And it is available in the market there, both from the private sector, but also from the multilateral sector, from organizations like MEGA, part of the World Bank Group. Mitigated currency and foreign risks. If you're taking out a loan in hard currency, but the asset itself is earning in local currency, there is a potential risk that the devaluation of the local currency will mean that you can't raise enough money to service the foreign debt. So again, articulating and mitigating that foreign currency and foreign currency risk is so important. And also making sure there's adequate insurance coverage. There are risks that the project parties can't necessarily take, but there are insurance companies out there that are willing to take on that risk at a premium. And it could be delay in startup, it could be inclement weather, it could be a whole load of different policies. Today, you can actually get epidemic and pandemic risk insurance. So the impact and the cost of we've seen in the last year is now an insurable event. It's not cheap, but at least it can be insured. So those are the keys for project success. But what is the reasons for project failure? I'll ask you all a question, actually, and please put in the sidebar. Between Europe, Africa, and America, which country do you believe has the highest failure rates for project finance deals? What do we have in the chat box? USA, Mirel, anybody else? I can't see any other responses there on the screen. But Mirel, you're absolutely right. The USA has the highest percentage-wise of failure in project finance deals. Can anybody tell me what is the cause of the failure in the USA around project finance deals? Again, please put your messages in the chat bar. Regulation. Echo, yes, it is actually. Well, it is in part. It's normally falls under the political risk. The failure of political risk in America is the highest cause of failure of project finance deals. And it's invariably because of the mismatch of regulation or legislation between state legislation and federal legislation. And when you look at perceptions, the challenge that Africa often finds is that the perception of risk in Africa is far higher than the reality. And that's why it's so important for project finance deals to be able to articulate the reality of the risks so that people can measure and price that accordingly. Where there is that gray area, where the known unknowns, the more unknown that is, the higher the cost associated with the perception of that risk. And so, in order to drive down costs in Africa, we need to work harder to give greater clarity on the unknowns in the risk allocation. But going back to the slide, reasons for project failure, government interference is often a cause for project failure, both in the preparation stage and also in the operational stage. So we can look across the continent and see a number of examples. Delaying completion with the increase in capital costs. One of the sort of most well-known example of that would be the Channel Tunnel, the railway line between the United Kingdom and France. That was a project that was delayed by many years, and the final budget was considerably higher than originally budgeted for, and that failed. But because of the political will, political support, both in France and the UK, they refinanced that deal further on. But it was a project failure. Technical failure. Again, we've seen some cases in the early days around in the power space where we're looking at second stage recovery. Some of the designs on those failed and didn't produce the output as required. Increased prices, shortage of raw materials weren't hedged, which again often happens in the construction industry today. We see steel costs have shot up considerably in the last year because of shortages are still in the markets. Decline in product demand and prices. So again, it's that predictability and reliability of the demand for the projects. Poor management, again, is another example, and not having sufficient coverage on insured risks is another cause for project failure. But one I haven't put on that slide is making sure that you have the right advisory team around you in structuring the deal from the very beginning is one of the best things you can do to ensure projects don't fail, and can give you the reality of what it's going to cost to get the deal and what the expected returns on the deal. I've done enough talking. That's the end of the slides, which I will share through the chamber. So please reach out to the chamber if you'd like a copy of these slides, and we'll go to the Q&A session.
Thank you, Stephen. Very informative. I've learned a lot from this, and looking at the chat going on with the sidebars, clearly a lot of people are also impressed, and I'm sure there are lots of questions.
So let me answer some of the questions in the Q&A parts. What's the difference between private equity, venture capital, and seed capital? Hamida. So venture capital and seed capital is very much those very early stage investors. Seed capital is a small amount of money that's able to grow the concept, the idea that's in someone's mind, into something that's articulated on a piece of paper with some research behind that to start a business. Venture capital are people who are prepared to take very high risks but expect very high returns, and typically you see venture capital in the tech space at the moment, where the failure rates may be as high as 70% in their investments, but that 30% that actually makes it are what they're looking for, the unicorns, because for every $7 they spend, they're going to need to recover that plus much more on the other $3 that actually give return equity. And they tend to exit fairly quickly from the investments once that sort of unicorn status is achieved. Private equity are people who are prepared to take that risk in the sort of growth stage of a business for a period of time. Typically, the private equity model will invest for about 5 to 7 years and then exit to either other private equity partners or strategic investors who are not prepared to take those early stage risks, but are prepared to pay a premium later on when the investment has been de-risked. And so their failure rates for private equity may only be 20%. And so their returns they expect over venture capital is very different. Temi, hedging, why is it so expensive to hedge in West Africa? And what are the potential options? So hedging is a risk mechanism, and if you're unable to measure that risk accurately, then people are going to put a premium if they're prepared to take that risk. And so if you look back a couple of years ago in Ghana, where we saw a devaluation of the CD at quite alarming rates at times, at the beginning of the year, you couldn't accurately assess what the exchange rate was going to be in 12 months' time. And so those who are prepared to take that risk will be conservative and say, okay, people might say it's a 10% devaluation this year, but we will sell a hedging contract where we're going to assume it's going to be 25, 30% devaluation. And if we win, great. If we lose, well, that's the risk we took. So it's around about the reliability and predictability of the macroeconomic environments and the impact on exchange rates, which is why hedging is so challenging in Africa. It's not just West Africa. Elsie, can I share a schedule of successful projects for Ghana since 2010? I actually don't have that schedule, but I'm sure people could look at a number of projects MPS, Tema port expansion, I would say, has been a very successful project. And you have a number of IPPs that have been successful in the project finance space. Dallas, what advice would you give an individual who has an idea but want to approach the government, banks and sponsors for a transportation project? Dallas, my recommendation would be, first of all, bring together a group of people who have the capital to deliver on the idea that you have, to ensure that you have credibility. Going to the government and seeking to get an MOU for an idea and then taking that around town and try and sell to people. There are too many people out there doing that, and they won't get the credibility from professional organizations that can deliver. So work with people who have shared values and ideas to deliver your idea, and present yourself as a consortium that can deliver the project to get engagement with both governments and banks. Olu, how can one significantly reduce the cost of preparing projects, that is, a bankability of a project? Good question, and it's an issue that is debated on many conferences every year, not just for Africa, but beyond Africa as well. And the multilateral agencies have worked on various programs. One is about standardization of documentation for PP or project finance projects, so that the cost of preparing the documentation is reduced through a standardization, and the cost of doing the due diligence of the banks is reduced because they know the standard documentation that's been presented to them. The other part of reducing the cost is actually, costs are often driven by the time consistency of parties over the period. Bankable, getting a project finance deal to a bankable stage is not a 1 month, 2 month, 3 month process. It can be multi-years, 5 years, if not longer sometimes. And so making sure that you have partners that have, again, shared values, shared vision for the project, and are prepared to be consistent over time in their commitments can considerably reduce the cost and the time required to bring a project to a bankable standard. Carl, projects in Africa running over initial costs, what could be accounting for such variances? Carl, could be a whole range of things. It could be from poor specification, poor project management, poor budgeting to start off with. The list is endless there, I'm afraid. Right, Letitia, is it normal practice for governments to mandate contractors and other parties who must be involved in project finance deals? So, the PPP Act that was passed in Parliament in December now basically codifies the process to do PPPs in Ghana now, where the governments are required to go through a competitive procurement process with transaction advisors. And so it will be for consortiums to come together to respond to those PPP opportunities. And it will be those consortia responsible for bringing themselves together and which contractors that they use. We do see in West Africa, did a paper a couple of years ago on the status of PPPs in West Africa. Some sectors are more prone to single source procurement approaches, particularly in Francophone Africa. And those tend to be in the more complex areas of PPPs. Increasingly, you're seeing in the port space and the power space that those tend to be competitively bid. William, turnaround strategies when a project fails to determine a suitable type of capital. So turnaround strategies will be dependent on the individual failure. If you build something where the market's no longer there, then it's a strategy is to find how you can repurpose that facility. If the turnaround strategy is, if the failure has been because of management failure, your strategy is replace the management. Sometimes it's not about capital, it's about parties. Mark, elaborate on a few key issues in developing PF transactions, debt equity ratios, financial ratios and covenants. So just at a very high level, your question really is warrants a much deeper discussion. But in basic terms, the project finance, you're looking to leverage in debt to be able to develop a project, because the sponsors don't have the equity to invest in, and more equity you put in, the higher your return expectations are. So with the debt equity ratios, typically the leveraging you'll see most people start off at is 70% debt, 30% equity. And the banks are looking to ensure that the equity shareholders have sufficient skin in the game to care about the performance of the investments. Their debt providers are not there to take equity risks, and they certainly don't have the skills to run assets if they fail. But that 70% of debt can only be sized if the cash flows from the project are robust and reliable enough to service that debt over time. And so where there is greater uncertainty on the revenue flows, the banks will not be willing to come in at 70% debt, but perhaps even push down to 50% debt and ask the equity to come in with 50% as well, or even lower. Now, so the debt equity ratios are a function of the reliability and predictability of the cash flows. I've seen some transactions that are more highly leveraged, up to 15% equity and 85% debts, where the off-taker is taking the whole capacity of the assets, and they're creditworthy and reliable, and the bank's comfortable on the commitments. And so that 15% equity, one ensures the sponsors have skin in the game, but they have also sufficient skin in the game to cover some of the completion risks as well. We talk about financial ratios and covenants. One of the features of project accounts is making sure that there is sufficient money in the accounts to cover the debt servicing. And so again, depending on the riskiness of a project, the banks will be looking for you to have at least 1.5 times the next debt service payment, or even longer than that, in the bank, so that they know that the money is there to pay the next debt service. And they'll have some transactions I've seen up to nearly 1.9% of the next debt service to have in the account as your debt service coverage ratio. But they then also have another trigger that if you go below, let's say 1.2 on the debt service ratio, that is an event of default, which then triggers a whole load of other issues in terms of banks looking to step in, or having a period of time for the sponsor to correct the failing and get back on the project onto an even keel. But as I said, Marla, your question really warrants a much longer and deeper discussion that we don't have today. John Ossay, interest rates in Ghana are relatively high for project financing. What strategies will employ to secure funds outside at a low cost? John, it comes back to the issue of the credit quality, the credit risk in a transaction. The more that you can structure the project to increase its credit rating in the eyes of the banks, the lower the cost of your debt financing will be. Commercial banks in Ghana, their cost of debt, where they get their money from to be able to lend, is expensive, and so that's why you often see it is high costs here in Ghana. And also the tenors that banks can offer are shorter than can be offered by some of the other international financing institutions. Okay. Olu, PPPs and project finance, complex transactions, what certifications and trainings? So it depends which path that you want to go into project financing. There's an institute called the Project Finance Institute that do training on financial modeling for project finance deals. I would highly recommend that as one to look at. So projectfinanceinstitute.com. But there are a whole range of organizations that can offer training. And yeah, please reach out to the chamber. They'll be able to direct you in the right direction for some of those organizations after this call. Julius, how can we reduce political risk in project finance to boost confidence in investors to cut down waste and excessive cost of projects? So, Julius, interesting question. Just recently, I was on a webinar listening to a speaker that talked about the person who was speaking was an investor into emerging markets, and their view on investing into emerging markets and how they identify markets to invest into was based on the reliability and the strength of the institutions and the court processes, so that if if you have strong institutions in government and that you have a reliable court process, that if there are any disputes, foreign investors can take reliance in those institutions in terms of their behaviors over periods of time. And if there is need to recourse to the courts, then the court system is independent of the political side. And they offered one example of two countries of divergence, that being North Korea and South Korea. 100 years ago, those countries were both at the same stage, and North Korea took the route it did in terms of the political leadership it has today, which did not encourage the building of institutions within governments or building up democracy and the rule of law, whereas South Korea went in an opposite direction. And today, you have two different economies there. One that investors are very willing to invest into because they don't see the political risk so high. The other, an environment where people are not willing to invest into. Idris, I'm afraid I can't answer that question, but the chamber can come back to you about whether the chamber will be investing in projects related to the OCTFA. Sorry, I've just got other questions in the chat bar. Kwame, the success of the Eurobond market. Really, that's outside the scope of this session, I'm afraid. But just one thing to say about the Eurobond market is that the money that's raised doesn't come with the same restrictions, just in the same way corporate finance does as project finance. So if you think of corporate finance for the private sector, its equivalent in the government space is the Eurobonds or the bond markets. I think that's covered all the questions that I see on the screen. Okay, Alice, I think that's covered the questions. I'd like to thank everybody for joining today and engaging with your questions. Over to you, Alice.
Thank you, Stephen, and thank you everyone for the questions. I think this has been very interesting, as I said earlier. Certainly learned a lot, and grateful for Stephen's time to present this to us. We're also very grateful and thank you for taking time out of your busy days to join us in this webinar on project finance. A recorded version of this webinar will be available on the UKGCC website and also on the YouTube channel. The UK Ghana Chamber of Commerce will continue to provide platforms for networking, advocacy, and trade services. So connect with us on Facebook, Twitter, LinkedIn, Instagram, and YouTube. And if you have any further questions, please contact Margaret. So 054, that's +233 054 012 6619. We hope to see you again on our next webinar. I don't know what that will be, but I'm sure you'll be getting some information on that. And thank you once again, and have a great day. Thank you. Signing off now.
Thank you very much, everyone. Have a good day.
Thank you.